Tim Baker, welcome back to the show.
Good to be back. What's good, Tim?
Well, I'm excited. We're going to be talking about questions to ask when hiring a financial planner, a topic that we've dabbled on before. We've woven in and out of this topic throughout the show in various episodes before, but we're going to directly cover 5 questions that should be asked, certainly not the only questions, but when you're evaluating a financial planner. And no need to take notes. We've got all of this information and even some additional resources in our YFP Nuts and Bolts Guide to Hire a Financial Planner. We'll link to that in the show notes so individuals can go get that resource. Tim, I want to start with maybe what is top of mind for many people, especially if they haven't worked with a planner before, which is some of the skepticism that may be out there in terms of working with a financial planner, engaging with a financial advisor, entrusting them with something that is so important, which is their own financial plan, and admittedly, an industry that doesn't necessarily have the best reputation. So let's start there in terms of that skepticism that may be there and where some of that may be coming from.
Yeah, I think a lot of the advisors that came up back in the day kind of came up through like the wirehouse model. So some of these big companies that we all know the names, or even the insurance world.
Mm-hmm.
And I think in those models, and again, this episode, we may throw shade on other models. There's no hate here. Like it's
Mm-hmm.
just they're different strokes for different folks types of things. And I've been in, a few, at least one different model, before we got into the fee only. But I would say, having been in other firms, it can be very transactional, Tim, right? Tim. So like, you look at the things that you have available to you as a financial advisor, and you try to find the best way possible to help your clients, but
Mm-hmm.
also to put like food on the table. Sometimes that can mean, squeezing clients into things that they shouldn't be in, and it kind of feeling like hey, I'm being pitched a product versus like, is this person truly in my best interest?
Mm-hmm.
I think the other thing that's part of this is, um, like, our industry is not transparent at all. When I come across prospective clients that have worked with an advisor or are currently working with an advisor, I'll ask the question like, how do you pay your advisor? And they'll say, I don't know, or I don't pay them anything, And I remember distinctly when I became a financial planner, I was talking to my parents, and I'm like, "How do you pay your financial planner?" And my mom was like, "Well, it's through your dad's work. They pay, or it's free, or something like that." And I'm like, "That can't be true."
Mm-hmm.
And when I uncovered how much they were paying, it was like heart attack city. It was just buried in a product somewhere, and they had no idea. So to me, I think it's that, and I think it's also like you hear stories about like Bernie Madoff, or you know really bad apples that you're entrusting your life's work, your money, to a person, and they do something that is fraudulent, and
Mm-hmm.
that kind of makes the headline. So it is similar to, like, I think, um medicine, or pharmacy, where you're definitely in a position of trust, right? And I think if you're a person that takes advantage of that, or is pushing a product or things like that, I think that that's where the public perception can be tainted.
Mm-hmm.
So it's earned, right? It's
Yep.
valid, but I would say the overwhelming majority of people that are out there, no matter what model they're in, they're trying to do their best to help their client. I just argue that there are different models that are better, that position the advisor and the client better, where there's less conflict of interest.
Mm-hmm.
Every model is going to have conflict, but that's what I would say is that, to that answer.
Yeah, and Tim, my experience too is there's a lot of overgeneralization based on your experience or maybe the experience of someone else that you then adopt that mindset or story. I'm thinking about my grandparents who I remember growing up, they had a financial advisor that wasn't necessarily a good fit, good situation. And in the eyes of my grandfather, like that person caused them a lot of pain. And therefore, like all financial
All of them.
advisor, right?
Yeah.
So,
Yep.
and that was fair. His concern, the harm that was caused in that moment, that was very fair. But as we'll talk about during the show, there are a lot of different types and flavors of financial advisors, financial planners. What does that term even actually mean? And when I think back to my own journey starting in this industry, before I had the opportunity to cross paths with you and learn more about the industry and what do terms like fee only and fiduciary mean, I remember very early on after starting the blog back in 2015, 2016, I started to interview various financial advisors, and inevitably, conversation after conversation, I often left with more confusion than I had answers. And I was trying to ask pointed questions, and I would leave with this kind of feeling of smoke and mirrors, not clear on, how are things being charged, what's included, what's not included. And then I was able to put terms to those things later after I would understand. But the problem that I had, and I see a lot of pharmacists falling into this trap in a similar way, is I applied my pharmacy training mindset and I tried to use that as the lens in which I was understanding the financial services industry. Because in pharmacy, right, there's variability between one pharmacy program and another, or one residency program and another. But at the end of the day, like, we know what a PharmD means. We know what a PGY1 or PGY2 means. We know what board certification means. And while there are some differences between institutions, there's accreditation and there's some level of consistency between those. And so we're able to adopt that understanding when we hear those terms. And I think that what I did and what I see many pharmacists do is we take that mindset and we try to apply that to financial services. And it really is, on some level, the wild, wild west. The term financial advisor in and of itself doesn't really carry a whole lot of
Means
weight.
nothing.
And so that's what this episode is about, is how do we ask questions? What questions should we be asking so that we as the consumer understand what are we actually talking about in terms of who we're working with, what the services include or don't include, and ultimately how do those individuals get paid?
Yeah, and I'll piggyback on that, Tim. Like, I harken back to when you and Tim Church were writing the Seven Figure Pharmacist book, and we had the
Right.
chapter on this, and like I was getting confused.
Mm-hmm.
So like if I'm in the industry and we're kind of talking about different, tranches of the industry and who does what, and I'm getting confused being in the industry, how does a consumer, a lay person, a pharmacist that is not versed well in financial services or whatever, how are they supposed to navigate that? It's
Mm-hmm.
super confusing. And, I think the other thing is like where pharmacists come from, like I'll say something along the lines, and won't get into this, is like, and I think it's 5% of financial advisors, financial planners, whatever you want to call us, are fee only fiduciaries. That means the other 95% are not, which means that they can put their own interests, the advisor, the planner's interest, ahead of their clients. When I tell pharmacists that, they're like, are you serious?
Right.
Like that doesn't sound like it would be legal or true, but it is. Like that's the way it is. And the 95%, I'm not saying that they're twisting their mustache and they're trying to find ways to defraud their people, their clients, but they don't have to necessarily put, they can say, hey, I can sell this product. I can make a case it is suitable for you, Tim, but it's not in your best interest. And I think that is a shocking revelation for a lot of people, and why we feel the fee only, the fiduciary. When I left my last job, I was not fee only. I was not fiduciary. And that was one of the reasons I broke away and started Script Financial, which is now YFP. And I remember having a conversation with, my mentor at the time, and he's like, I get it, but he's like, do you think that I would do anything that kind of, would not be in the best interest? And I'm like, no, I don't. But early in your career, or just, if you get into a money pitch, I think it puts you in a tough spot to say, okay, I can pay off this debt or whatever, or I can make sure that my clients are, kind of on the up and up. So I think there's better models, to reduce the conflict. There's never going to be a model that there is no conflict of interest. And I think that's important to know. But I think, to me, a theme in this conversation will be transparency in what you're paying, the service that you're getting, how you're paying your advisor. I think that's huge, right? Because in an industry it's very black box of like, okay, how does this actually work? And again, I've been in that model. When a client would ask me, hey, how do you get paid? Previously, I'm like, well, I can sell you an insurance product. I can charge you, hourly, all the things that we're going to talk about. And it's like, okay, what does this actually mean? Like, what does that mean to me? And it's a little bit of a chicken and the egg. It's a catch-22, because like, until I start working with you, Tim, I don't really know what insurance product you need or
Right.
how much you need or
Or
what's
what you
that going to
don't need.
cost.
Right.
Right.
Yeah.
So it's a little bit, it's not all on the advisor. It is a little bit
Hmm.
of like, you don't know until you know type of thing.
Yeah.
But that just leads to a lot of like, what the heck, what does this actually look like? So yeah.
Tim, before we jump into the 5 questions, your share just reminded me of the John Oliver piece last week tonight. We'll link to it
Yeah.
in the show notes if you haven't seen it before. I just looked it up real quick. It was back in 2016. I can't believe it's
Yeah.
almost 10 years ago, which is wild. But he has a great piece on retirement plans that really highlights well in an entertaining way some of the fiduciary fee only types of concepts that we're talking about. So if you're looking for some reinforcement or seeing that from a different angle, make sure to check that out. We'll link to it in the show notes. Tim, so we're going to walk through 5 questions to ask when hiring a financial planner. Again, these aren't meant to be all inclusive. Of course, there's more than just 5 things we want to be thinking about. Um, and some of these seem very obvious, which question 1 is the case, but these are things that we can overlook as we're in the decision-making process of working with a planner. And so I encourage people before they go out and determine what is or is not the best fit for them, have these questions in your back pocket, right? These become the framework in which you can use as you're evaluating some of the different options that are out there. And that first question we have, Tim, is what's your process for offering financial planning? AKA, what does financial planning actually mean when working with you or working with your firm, right? We talk about that term a lot, a financial plan, financial planning, comprehensive financial planning, but this can look and be very much apples to oranges between one firm and another. So before you sign the dotted line and you pay any fees, what are we actually talking about, right? What's included in here?
Yeah. And I think most advisors, this is going to be super generalized, but I think in most firms, it's very investment centric.
Mm-hmm.
So investments and retirement, I think it's probably pretty product centric, like insurance, life, disability, um, and then probably some light financial planning. If I had to paint a broad stroke of what the industry offers, um, and so it's important to know, like what it is. So like if you say, hey, it's financial planning, like what does that actually entail?
Mm-hmm.
I think when I started Script, the going, I think thing I heard from pharmacists that I started working with was, the advisor that they would work with or they would talk to, it would say, hey, don't worry about your student loans. Like they'll figure themselves out,
Mm-hmm.
which we know is terrible advice. I'll set up a Roth IRA. I'll invest that for you. I'll sell you a crappy insurance product that you probably don't
Mm-hmm.
need. And then I'll talk to you every couple years until you have assets for me to manage.
Mm-hmm.
So that was the way for them to help, them. And I looked at that and I'm like, there is a huge gap in the market because we know, often, especially if you're in your new practitioner years and maybe plus, like the tail that wags the dog for your financial plan are the student loans. So as this, if we have 106 figures worth of student loans, that's the tail that wags the
Yeah.
dog, right? So as the loans go, so does the rest of the plan. So I looked at that and I'm like, this is a super underserved, community of people. And that's what I really hung my hat on in terms of the business model. So that would be the question I would ask. It's like what that actually looks like. For us, the way that we do this, Tim, is, I would say that we are very comprehensive, right? So we look at what we call delivering the financial roadmap over the first year of our
Mm-hmm.
engagement. So once you become a client, we go through the onboarding process. We, part of that is linking all the things to your client portal. So we have a client portal that, you link your checking, your savings, your
Mm-hmm.
credit cards, your investments, the value of the house, the mortgage, the student loans, all that stuff. And for a lot of people, it's the first time they see all of their stuff in one spot, right?
Right.
Because we bank over here, we have investments over here, we have debt over here. If you have a spouse or a partner, sometimes like that's a little bit of a black box if you can't directly see. So it feeds all this information in a read-only fashion. And when we deliver this financial roadmap over the first course or the first year, the first stop on that roadmap, Tim, we call the get organized meeting. So that's where
Mm-hmm.
we're going to go line by line through all the things. And what we're really trying to establish here, which again, I think is overlooked, is what is your starting net worth? What's
Right.
the first data point? What's the before picture, so to speak? So that's the first stop. The second stop, once we establish that, is okay, now that we know where we're at, let's talk about where we want to go. So we call this second meeting the script your plan meeting. So
Mhm.
this is, um, hey, I want to retire at this age. I want to make sure I take these trips. I want to
Mhm.
pay for my kids' education. I want to take care of my parents that are, that are aging. I want to, retire by 60 or 65. I want to volunteer. Whatever those things are, we got to know where we're going. And I think
It's the why.
sometimes,
Mhm.
yeah, I think sometimes planners will do good at kind of the, hey, what are the investments? What are they? But they don't necessarily do a deep dive on like the
Mhm.
why. So YFP drinking game, if you've ever heard me say it depends, right? When a pharmacist asks the question,
Mhm.
it depends on what's the balance sheet look like and what are your goals, which are going to be unique to you, right? So this is where I kind of scoff a little bit at the water cooler talk of like, oh, my colleague's doing this, my colleague,
Mhm.
my uncle's doing this, my cousin's doing this. You're a unique snowflake, Tim. So your balance
Mhm.
sheet and your goals are going to be unique to you and Jess. So we have to tailor the plan to that. And I think those two foundational meetings, which, in the beginning of where are we at, where are we going, changes the it depends to this is what I
Mhm.
think you should do. This is in your best interest. So to me, it's important to take those steps. And then really meeting three and beyond is on the roadmap is getting to the meat of that. So
Yep.
everyone starts with fundamentals. So we look at cash flow and budgeting. We look at a savings plan that's going to be anchored by an emergency fund. But if you're like, hey, I'm a big traveler. I want to see a travel bucket.
That's
I
right.
want to see a
Mhm.
home purchase bucket, a home maintenance bucket. Maybe it's a kids bucket. So the short and medium term goals, which are not necessarily suited for like longer term investments, we have buckets of for us to be able to fund those goals. So it's cash flow and budgeting, it's a savings plan, and it's a plan for the debt. So
Mhm.
often that's a student loan analysis. It's like, hey, I have credit card debt, I have
Yep.
car note, I have a mortgage, I have a line of credit. How are we efficiently what's the optimal way to tackle that debt?
Mhm.
So that's kind of the foundation for which longer term planning can then sit on. So really we get into retirement planning, investments, how much do I need for retirement? I tell the story that back in the day, we would say, hey, you need 2.6 million to retire. And then we were on to the next thing. Well, how can we actually break that down to a number in
Mhm.
2025 that actually makes sense? Or, hey, I'm 5 years away from retirement. What does that look like? How do we then start? I think one of the things that the CFP does well, Tim, is they're good about, hey, the accumulation phase. But
Yep.
once we get to retirement, what the heck do we do? How do we turn these big pots of money into a paycheck for time unknown?
Mhm.
We don't know how long we're going to live. So investment and retirement, A to Z, we manage investments at YFP. So we have a custodian that, we set up accounts, we move accounts over from other custodians. We buy and sell all that stuff. We do conversions. And then really the last two meetings, Tim, is going to be things like wealth protection. So meeting 5, we do insurance planning. So do we have the right life,
Mhm.
disability, professional liability? If you're getting to be my age, you start thinking about long-term care insurance. Do we buy our own policies? Do we just get the policies through our employer? The
Mhm.
big difference between us and a lot of the other guys and gals is, if I say, hey, Tim, we think that you should get this life insurance policy, it's not because we're lining our pocket with additional commissions, because we think it's in your best interest.
Yep.
So, some of those open enrollment questions that you have with your employer, we work through. And then lastly, the big thing is the estate plan. And I often joke this is the redheaded stepchild
Mhm.
of the financial plan. I can say that as a ginger, but often forgotten. But do you have the proper wills, living wills, power of attorneys, trusts? If someone depends on you, or if you have a pulse, like these things are really important to have in place. So we get those documents in place as part of our fee in the state that you live in. Or if you have those in place, we evaluate them and
Yeah.
then make sure that they're good. So the meat of our financial plan. We also do things with like business planning at a high level, salary negotiation, which kind of stem from, hey, Tim, I got a new job. And I would say, great. Like, what did you counter? And they're like, I didn't,
Mhm.
I was just happy. So things that are kind of, more tangential to the plan, we'll look at. But I think it's important to kind of go back to the root of the question to say, okay, what does the service actually look like? What am I getting? And be clear about that, because I think often if you say, hey, I do financial planning, a lot of the time it's very investment centric.
Yeah.
It's very insurance product centric, and that's it. So um, be it's a question I would definitely put at the top of the list.
Yeah, one of the things I've heard you say many times before, Tim, as it relates to our services is, hey, at the end of the day, if it has a dollar sign on it, we want to be a part of the
Yeah.
conversation.
Or at least
And
quarterback a solution.
yeah, that's right. That's right.
And we've had clients recently that are like, or prospects that are like, I've been working with someone at XYZ firm, and I have $250,000 in student loans that I need to figure out, 10 years after I graduated. No hate. And can you help me with that? And I'm like, well, if you're paying your advisor thousands of dollars that you don't know like, why are they
aren't
not
they
helping?
helping?
And they're either saying, hey, I have a guy or a gal that can help you, that I can outsource this to you, or I just can't help you. And to me, that's unfathomable. One of the things we have to be aware about is like, we can't give advice on things that we don't have education in, or we're not certified to do. That's important to remember. But I would never look at a client and be like, I can't help you. I would at least try to find a resource for them. If someone's like, I really want to invest in a franchise, that's not in my wheelhouse, but I would try to find a resource that would say like, okay, like how can we go about it? I want to quarterback a solution. So that's one example.
Yeah. And I think the point that we're trying to make here, as we're talking about this first question, right? What's the process for offering financial planning is are you clear on what that term means as a part of the engagement? And is that in alignment with what you need and what you want? And as Tim kind of articulated, our roadmap, right? The idea is we have clients coming to us that are looking for service, and we're trying to determine, hey, what's going on in their situation? What do we offer? And is there a good fit? That roadmap is a visual to say, this is the expectation of what you're going to go through over the first year. So before we make, and it's important, this is a joint decision. Is it a good fit on both sides? Before we make that decision, are we clear on what's included? And is it in alignment with what you need? And then there's some more granular questions here, right? Exactly. Are we clear on how many times we're going to be meeting, how we're going to be meeting? Is that virtual? Is it in person? Is it over the phone? What does that look like? What's the technology and the software that we're going to be using? What do I have access to in terms of tools and resources? Hey, if I have a question in between meetings, who do I get in touch with and how will that be received, right? All of these are important considerations that you want to be clear on before you engage. And as Tim mentioned, as we look at our service in particular, compared to kind of what's out there in the general population of financial services in the industry. And what we're referencing here is a study that's done by Michael Kitces annually, who's a leader in the financial services space, looking at what are the components of the financial plan, what's typically covered, and how often are you typically meeting with an advisor. Tim, what we usually see is most advisors are looking at an annual engagement or thereabouts, correct?
Yeah. I mean, there are, some advisors that are just like hourly, so it's more transactional in nature. Most advisors, when you go to work with them, you work with them for life or for many years, right? It's less, I think it's less where it's more you're in, you're out, that type of thing. I mean, and that's for us from our perspective, like we're trying to build relationships with clients that we're going to work with for many, many years for the long term. So yeah, and looking at the graph that he has, I'm looking at it. That will, I'm sure we'll share in the notes or at least a link.
Yep.
The things at the top, components included in the financial plan: retirement, 98% of advisors, help with retirement; investments, 96%; tax planning, 92%; Social Security, 86%; estate planning, 84%; life insurance, 82%. So these are things that it's almost like, when you think about, when you ask the public what a financial advisor does, like that's what it is. The analogy is like when you ask the public, well, what does a pharmacist do? They think about someone, counting pills, standing behind the bench. We know there's a lot more that pharmacists can do. But if you look at the bottom of the graph, I look at things like held away 401k, 45%.
So this would be like an employer 401k.
Yeah. So something that you're currently contributed into, which this is bonkers to me. And then oftentimes outside of the house, it's the biggest asset that you own. So more than half of advisors. So Tim, you hire me. I'm going to sell you insurance. I'm going to set up your IRA at my custodian, a brokerage account. And then you're going to say, hey, Tim, thanks for all that advice. can you help me allocate my 401k at Vanguard or Fidelity that, my employer's contributing, and I'm getting a match? And they say no. That's nuts to me. Like, that is crazy.
Well, especially what we see, Tim, a lot of our clients, hey, I've been working with Kroger for 10 years. Or I've been at this hospital for 12 years. I mean, this easily for some people, it's $500,000 or more. Could be much more if they're further along, right? Until those might roll over to certain buckets. So this is a big part of the plan.
Yeah.
Yeah.
Yeah. I mean, college funding's, I would say, only 71%. So if you're kind of a older millennial, younger, maybe younger Gen X, like that's kind of the world I'm in, is like, that's a big part that I have to look, we have to look at. Employee benefits, 50%. Again, I look at that as that's a major part of your comp. Like, that's something I would want to look at and make sure that you're optimized. The one that's a little bit higher to me, Tim, life plan is at 49%.
I saw that. Probably interpretation of what that is.
Yeah, like how you define life plan. And we're big proponents of, you build out a life plan that's supported by the financial plan, not the other way around. And I think if we look at like transformation and impact, a lot of it is centered around like a life plan and story. But
well,
that's
I'm looking at student loans too, to the point you just made of a couple prospects here in the last week, right? 31% student loans. So that matches a lot of what we're hearing of. Hey, I work with an advisor, probably who's helping with retirements, insurance, et cetera. Most likely not in a fee only. We don't know that for sure. And hey, they don't know what to do with my student loans. That data, only 31% of advisors. Part of that is generational. They may not work with clients that have many student loans, but we also know from experience with people that come our way that there are often advisors that just the borrower still has that debt. They just aren't helping them. And for the reasons you've already mentioned, it's really hard to advise on the rest of the plan if you have a couple $100,000 of debt.
Yeah, I mean, if you have a couple $100,000 of debt, like, who cares about your investments? And I say that somewhat facetiously, but it is the tail that wags the dog, right? You have to figure out the strategy and the plan. And I kind of ache in the student loans a little bit too, like digital assets. So back in the day, again, when I got into the industry 10 plus years ago, the advice was, we either can't help you with the student loans, or don't worry about the student loans. You make a great income, they'll figure themselves out, or pay the one with the highest interest rate or the lowest balance, which is the snowball and the avalanche method, right? Which we know, Tim, it's crap advice for your student loans. And I remember having this like debate with an advisor that was very like investments, insurance, blah, blah, blah. And they're like, well, what's the big deal? It's just like paying off your house or anything. And I'm like, if you have $250,000 in student loans, the impact on your wealth building could be anywhere where you pay 80 grand if you're in a PSLF and you're completely optimized. So think about that as like a negative interest rate, to you're paying $500,000, $600,000 if you drag it out over 30 years.
Totally.
And he's like, oh, okay. Like, that's the spectrum of outcomes. And to me, it's just really important, right? And I don't want to just harp on student loans, but I get 31% of advisors, they're either saying I can't help you, or I have a person that I can direct you towards. 6% career salary benchmark. And I think like if we weren't as niche, like if we worked with pharmacists and attorneys, and we do work with everyone, but our niche, I would say probably 95% of the households that we work with, Tim, there's a pharmacist in the household. But we kind of like, I just got to the point of, again, a client would say, hey, Tim, I'm changing jobs. I just accepted this offer. And I would say, did you counter? And they're like, no. And I had a client recently, shout out to her, who recently came on, and she's like, I'm fixing to get a job offer. Can you help me with that? And we did, and we earned our fee that day. Like she got more base, she got a bonus, she got some stock. And she's like, I would never have thought, or I don't have the confidence to do that. And to me, it was just kind of like, the income is what feeds the financial plan. What sticks is your net worth, things like that. So to me, it's important to at least advocate for yourself and have the tools and the ability to do that. So it's kind of a tangential thing. And I personally still do it. I love doing it. That's probably the one thing that that and some of the business consultant stuff that 20% of the advisors will do. But these are all things that I think, I think, to go back to the question of like what's included, And then from a frequency perspective, the overwhelming majority of financial planners, they're going to meet with you 2 or 3 times in the first year to kind of complete the plan. And then after that, it's typically every year or every couple years in terms of like maintaining the plan. For
Mm-hmm.
us, like our delivery of our roadmap is typically 6 or 7 meetings over the first year, typically 7 meetings. And then we go into a semi-annual kind of rhythm, which is about 10% of advisors will do that. Um, so high touch. And we typically do like an annual review and then a plan checkup.
Mm-hmm.
The warm blanket, though, that I think, and this, when I spoke about that sour negotiation, the warm blanket with working with a company with YFP, and I think most firms are like this, but is if there is something that's super time sensitive, like, hey, I got a job offer, or we're buying our house, we're selling our house, there's a
Investment
layoff,
property. Yeah.
investment property. Hey, guess what? I'm retiring. I thought it was going to be in 3 years. Now I'm retiring now. You can meet with us PRN as needed, right? And we used to not call them, we used to just call them we call them PRN meetings now. So as needed, you can meet. And that to me is like, hey, we want to be able, and I think sometimes if you're paying an advisor like hourly, and I kind of always joke about, remember Tim, we've had attorneys in the past where it's like we would pay them hourly, and I
Keep
would
the
spend
email short.
the email, and then I would spend the first 45 minutes reminding the attorney of like who I am, what I
Oh my
do, and
gosh.
then get this huge
PTSD.
bill.
Yeah.
Like
Yeah.
and again, no shade to hourly planners out there, they exist. But to me, it's super transactional that
Yeah.
I don't want people like counting hours or anything like that. So, yeah, I would say comparatively super high touch with regard to the frequency.
So brass tacks on this first point, and we're intentionally spending the most time here because this is the meat on the bone, right? In terms
Yeah.
of, are you getting what you need? So brass tacks here is, does what you need and what you're looking for help with the financial plan? Does it align with what they offer? Does what they call financial planning advising, does that align with your needs for the plan? And I'm going to put a plug here, Tim, for us. We are beta testing what we're calling a second opinion analysis. Maybe we'll change the name on that. Maybe we won't. But the idea is for those that are already working with an advisor and having this nagging feeling of, hey, I'm not sure it's the best fit, right? Whether it be frequency of meeting or questions getting answered, or maybe a lack of transparency in the fee structure, or hey, they don't know what to do with this part of the plan. There could be a myriad of reasons. Um, Through the second opinion analysis, our goal is that they have an opportunity to sit down with you. We can learn a little bit more about what's going on in their situation, do an analysis of the current engagement, what fees are being assessed, whether that's transparent or not to them now. And then, of course, we can talk more about our services and see whether or not it makes sense to move forward. So we're looking for some people to help beta test that for us. If nothing else, I think it would shed some insights on the current engagement to help us refine our processes a little bit further. So if you are currently working with an advisor, you have that feeling of, hey, I'm not sure if it's the best fit, and you'd be open to helping us out, do a second opinion analysis, send us an email, info@yourfinancialpharmacist.com. Just say second opinion, and we'll get back to you and get something scheduled from there.
Yeah, I'd love to be able to do like 3 to 5 of these, Tim.
Yeah.
Just kind of beta test and see what this looks like. And I think the way that I'm looking at this is, the analysis will kind of be similar to like what we do. We do a portfolio insight for our clients, and it kind of looks at, the account location. So like what and where your accounts are. So like when we try to build a retirement paycheck in the future, we want pre-tax accounts, we want
Yep.
taxable accounts, and we also want like Roth, like after-tax accounts. So account location is really important. The other thing is allocation. So, kind of evaluating, what are your percentage to stocks and bonds. We another section we talk about is move money, which is if money is moving in or out of your account. So much about is of this is as how much you're investing, not what you're invested in. And then like expense, like what are you actually paying for those investments, and kind of put some investment analysis reports with that, and you can kind of hear my thoughts on your portfolio. So I would say look into three to five guinea pigs to kind of pilot this and see what it looks like. Would love to do that. So yeah, just email us and we'll figure that out.
Again, info@yourfinancialpharmacist.com. Just note second opinion in the subject line or email, and we'll get back to you so you can get on Tim's schedule. Tim, second question here is, are you licensed, if at all? Are you licensed as a stockbroker? Are you licensed as an insurance agent? Are you licensed as an investment advisor? Why is this question important?
So I think this kind of shows you like the underlying way, like the underlying model that they're in. So I would say the three main models that are out there are fee only, which is what we are, which I think makes up about 5% of advisors out there. So this is where you essentially pay for advice. You don't pay for an investment product or like an insurance product. So no commissions. So if you're working with a planner, or if you're looking at a planner and you see like, um, securities license or insurance sales, like that means that they are commission. So you have fee only, that is kind of like we feel the best, the most pure in terms of like, less conflict of interest. And then
Mm-hmm.
on the other side of the spectrum, which I don't know if these guys and gals are around anymore, but it's basically like a commission only. So this is like, you see on the movies where you call up your stockbroker or they call you and they say, hey, I want to sell you,
Mm-hmm.
100 shares of XYZ company, and it's more transactional. They're selling you a product, they get their commission, they move on. So a lot less in terms of advice, right? So that's the two ends of the spectrum. In the middle, where most advisors live, it's called fee and commission, or we typically call it is fee based.
Mm-hmm.
So oftentimes, you know, um, a prospect will come to me and says, "Yeah, I want to work with you because you're fee based, you're fiduciaries," and that's actually a misnomer. We're fee only. And they sound similar, which is part of the problem. But
Mm-hmm.
a fee base is fee and commissions. So this goes back to like, in my previous model, Tim, if you were my client, you would say, hey, Tim, how do you get paid? I'm like, pull up a chair. It's going to take me a while. I can charge you hourly. I can charge you a percentage of AUM, assets under management. I could sell you a life insurance product and get a commission. I could sell you a disability policy and get a commission. I could sell you an annuity and get a commission. I could sell you, whatever. So it could be a flat fee.
Yep.
So and again, there's no shade, because I think what those advisors are trying to do is, when I was in that model, Tim, I thought we were awesome because we didn't work for one of the big wirehouses that we had to sell their proprietary products. We were like, we could sell whatever we wanted. And then I found out about fee only, and I'm like, oh, like
Mm-hmm.
that's what I want to be. Like, I don't want
Mm-hmm.
my advice to be kind of directed by a product. I want it to be directed by the advice, the
Mm-hmm.
plan that's in the best interest of the client. So those are the three broad buckets. So it's fee only, which is, no commissions. Essentially, you have commission only, which I don't know if they exist anymore, because now we have E-Trade and Rob. We have access to the
Yep.
markets, right? And then we have everything in between, which is typically fee based or fee and commission. So, you can look at an advisor website. So sometimes I'll talk to an advisor like, hey, I'm working with this group or whatever. They're fee only, they're fiduciary. And I look at the website, I'm like, respectfully, they're not, because
Mm-hmm.
at the bottom, there's disclaimers about, so if they have like a series 7, which is one of the first exams I passed when I got in the industry, that means that you can sell securities and earn a commission. If they have insurance, which I used to have also, if they have insurance licenses, that means I can sell you life insurance and earn a commission. I had to give those up, the Series 7 and the insurance stuff, when I transitioned to fee only. So I think these are more important to kind of understand the model in which they're in, because I think even people in those models don't know what model they're in. They'll say, hey, I'm a fiduciary.
Yeah.
Well, are you a fiduciary all the time, or when you're just talking about this specific thing?
Yeah.
And that's the thing that gets super confusing.
Tim, if I'm someone listening, maybe I work with an advisor. I have worked with an advisor in the past, or I'm looking to work with an advisor, and I'm trying to answer this question, like which of these three models do they fit in? Um, we know that most people are probably in that middle one you described, that fee based. Um, how do they figure this out? Is it information on the website, disclosures? Is this where the ADV form comes in? Tell us more about that. If that's the case, how do they do their homework on this?
Yeah, the first place I would look at, like, first, like really quick, like when someone says, "Hey, I'm working with this," and I'm trying to suss out like what they I look at their website, and typically at the bottom there'll be, we use this broker dealer. If you see like the words broker dealer, that's typically their fee base, their fee and
Hmm.
commission. If you see things about insurance things, so typically at the bottom of their website there'll be some type of disclaimer that says like who they're affiliated with. You can ask them and see like, the circles they might talk in. And then I think the last place would be like go to I think it's brokercheck.com, and you can basically look at their ADV brochures. So the ADV, I'm not even sure what the ADV stands for, but it's basically there's part one, part 2A, part 2B. 2A is going to basically say, it's like, for us, it's like a 40-page document that kind of says,
Mm-hmm.
this is who we are, this is the services that we provide, this is the fees that we charge, and it kind of gives you more of the detail. So if you see things like insurance or again, security sales, things like that, you're going to be working with probably a fee-based advisor. So it would be ask them, it would be look at the website, and I would say I would go to BrokerCheck to look for the ADV brochures.
We'll link to that in the show notes. Is brokercheck.finra.org.
Yeah.
So you can enter in an individual or a firm. So we'll link to that in the show notes. And then we'll also link to the page where it has YFP's ADV forms if folks are curious at looking at those more carefully as well. So get out a cup of coffee. It's not always the most exciting read, but it's an important one. All right, good stuff. Let's continue the conversation then as we move to the third question. We start to talk about not only how are individuals licensed or which of those three models they're in, but how do they ultimately get compensated? And again, sounds obvious, but we'll talk with a lot of folks where, hey, what's the current engagement look like? How are you paying for services? And it's either I'm not sure, or the one I've heard several times before is like, I don't, right? It's free financial planning, no such thing. So third question here is, how are you compensated, and what ultimately is included in that fee, and how is that calculated, right? And is that fee transparent? Tell us more about this one.
Yeah. So I think that's the big thing is transparency, right? So like we're a
Mm-hmm.
business, we're in the business to, build a profitable business, make money, all that kind of stuff. So like, it's important to say that out loud. We're not this, we have YFP Kids, which is a nonprofit. Our main business, your financial pharmacist, is a for-profit company.
Mm-hmm.
So transparently, like, we want to make sure that's out there. I think, the way planners get paid, some of the things I talked about is like insurance and investment products. I have a memory, Tim, of, I was working with my previous firm, and they're, one of the guys in our office is like, hey, if you have the opportunity to sell your products like a non-traded REIT, do that. And I'm like, well, why? Like, what's the benefit?
Mm-hmm.
It's like, it pays 8% commission.
Oh, geez.
And I'm like, I need to take a shower. Like, it just is like, yuck.
Mm-hmm.
Right. So it's the same thing with like variable annuities. Like, hey, why pay variable annuities? It's because the commissions are so. I often say is like, typically the products that are better for the planner, the advisor, are not good for you. So, you know, if you're, so when we work with us, the only like we basically set the table and say, hey, Tim, you need XYZ insurance policy. And then we hand you off as someone that's going to sell the policy and not try to upsell you. Like, we have,
Mm-hmm.
insurance companies that, work with fee only, that understand that. So you pay for the advice, not the product. That person that we send you to, they get the commission, right?
Mm-hmm.
So there's a arm's length, in
Yep.
that regard. Anytime that you mix the sale of a product with advice, I think, again, where you have the most conflict of interest. So, if you're looking at a statement and you're like, I don't really know how my advisor gets paid, often there'll be like an advisor's like fee that you should see as a line item, but sometimes there's not. A place that you could look at is like when you sign a client agreement to begin your engagement with an advisor, it should lay out exactly like what you're paying. But a lot of people just don't look at that, or they don't know.
Mm-hmm.
Typically when we sign clients, we go through the agreement together. And I do that in the spirit of transparency, Tim, because I want to know, I want people to understand like what they're paying. And part of it is to combat the lack of transparency
Yeah.
in the industry. And I always kind of go back to like, when I bought my first house many, many years ago, Tim, I felt like I was signing a tree and I couldn't ask questions. And I just hated that feeling. So I want clients to say, hey, Tim, what does this mean? What does that mean? And we go through it together. Same thing with the invoice. So, but if you're looking at a statement, there should be it says something like advisor expense or fee or commission. A lot of the times, like a mutual fund, it'll say like, it'll have like an A or a C next to it.
Mm-hmm.
And that indicates that it's an A share mutual fund or a C share mutual fund, which has commissions tied to it. You just can't see what it is. So if you have XYZ mutual fund and it says A, you would look up that mutual fund and you could see it's called a front loaded fee or a front loaded commission. It says that, okay, you paid 5.75% when you made that initial.
Yeah.
But it's like, you have to know that to like look for that. So it could be fees, it could be commissions on products. Probably the prevailing model that most advisors use is called AUM, assets under management. So this is a percentage that the advisor is managing directly. So they'll typically roll over your investable assets like an old 401k, an IRA, a Roth IRA, a brokerage account. They'll move it to their custodian and then they'll manage it directly, and then they'll charge a fee out of that. The problem with that model in its purest form is, what I found is that if you don't have a $500,000 or $1 million, the advisor will say, hey, Tim, would love to work with you, but I can't help you unless you have this money. Or they'll say, the way that I can help you is sell you a crappy insurance product. I'll invest what you have, and then I'll talk to you every couple of years until you have assets for me to manage, i.e., where you can pay me. I think the one of the main conflicts of interest is that the more dollars that they're managing, the
Mm-hmm.
more fee that you're going to pay, right? So, they're incentivized for you to move, accounts over to them. So that's the prevailing one. Another one is called AUA, assets under advisement. So this would be what they're managing as well as what they're not managing directly. So a held away 401k, some advisors will put all of that into a bucket, and they'll say, oh, they're going to charge a percentage of that. Could be flat fee, where it's just, hey, it's this fee, and that's it. It's a flat $5,000 a year, $10,000 a year.
Yep.
And the problem with that fee typically is you often see major increases in the fee over time because there's no mechanism to kind of account for inflation, salaries going up, things like that. Or they're typically higher. Like a lot of flat fee, it's just like, hey, our minimum fee, flat fee is $7,500 or 10 grand or things like that. So flat fee is definitely one, and then hourly, an hourly fee. And then there can be combinations of all these things,
Mm-hmm.
Tim. But
Mm-hmm.
those are the prevailing, some people do hourly plus a percentage of what they do, or, it's an AUM or, plus, they might charge AUM and then they'll charge a planning fee in some way. So that's the big thing to understand, is that there's lots of different models out there, lots of different ways to kind of skin the cat, so to speak, and just understanding, who you're working with and how they charge.
Tim, since AUM is the prevailing model, you did a great job of talking about all the different buckets, right? They can get paid from commissions, and then from a planning perspective, typically we see it's either AUM, to a lesser degree AUA, assets under advisement, which, as you mentioned, would include some of the held away. So
Yeah.
not only what they're managing, but also, hey, dollars that you have, for example, inside of a 401k, your current employer. And then you mentioned the flat fee. Could be a lot of variations of that in terms of both amount and what that looks like. And then, of course, something like an hourly, more of a project type of work. If we go back to the AUM for a moment, given that that's the prevailing model, give us for instance. So, what is a typical AUM fee? Certainly not consistent across the board. And then let's say we have a client who's got $400,000 that would be managed by an advisor under an AUM model. What that might look like in terms of fees?
Yeah. So typically I would say the prevailing model is typically something that, for an AUM model, it's like 1% that's tiered down, right? So if if you have $500,000, 1% of that, that the advisor managing, 1% of that is $5,000 a year that they're going to build directly out of your investment accounts. Um, that's typically the prevailing. I was talking to a guy that Liam plays soccer with over the weekend. He works for a big company based in Columbus, and their model is ultra high net worth.
Mm-hmm.
You have to have a minimum of like 1 to 2 million, and their fee starts at about 1.5% or something there. So it's all over the place, but typically the one that I see most is like 1% that's tiered down. So the more that you invest, the fee goes down or the percentage that is charged over time. The way that we do it, I was admittedly pretty anti AUM when I started Script back in the day, Tim, and there's probably hours of footage on our podcast, me kind of exclaiming that point. And I think the reason why I was anti-AUM is because I actually think that the model is somewhat elitist. So it kind of it kind of kept a lot of people that needed advice, i.e., a 20, 30, 40 something year old pharmacist out of the market.
Excluded them.
Excluded them. Because again, the prevailing advice was don't worry about the student loans. I'll invest your Roth. I'll sell you an insurance product, and that's how I can help you. Or they're like, hey, I can't help you until you have that money. So there's lots of different reasons. So we've essentially adapted over the years kind of a hybrid flat fee AUM model. The positives of the AUM model is like because it's the most prevalent, everyone understands it, and everyone from a compliance perspective, they kind of understand like
the SEC likes it.
Exactly. The SEC likes it. They understand it. But I think one of the big things that we've discovered over working with hundreds of pharmacists is the AUM model. Even though money is fungible, meaning your money is your money, whether it's in a brokerage account, an IRA, in your checking account. What we've discovered is that the model that we would charge, especially early on in our business, would be very much in the realm of, hey, like we don't really care where the assets are. So if you want to manage it or whatever, we're going to charge you a flat fee, and you're going to primarily pay that out of cash flow, your checking account, your credit card, et cetera, either as because you need to, or because you don't have assets, or just because that's your option. The problem with that is that the paying out of cash flow is more disruptive to your life and your lifestyle. So if I'm billing you quarterly on a financial plan, eventually you get some fee fatigue. And if you believe like us that the best results come from the longevity of the relationship and stacking years of very intentional financial planning that yields the best result, that's a problem. So the AUM model, so if I'm billing you, X amount of dollars per quarter out of your checking account or your credit card, that's very different, even though it's the same amount, if I'm billing it out of a couple $100,000 of assets. It's a little bit of out of sight, out of mind, even though it is your money, right? I want to make that clear, but it doesn't disrupt your lifestyle, so to speak. So our model is kind of adapted to, essentially, if you have less than $500,000, we're going to charge you some type of like flat fee that's based on complexity. Anything above that is just going to be based on, a percentage that's tiered down on the assets that we're managing. And I think the other thing that we changed is like we used to be more agnostic about who's managing the assets. Now we're not. We've experimented with that where it's like you can manage it or we can manage it. It was too many cooks in the kitchen. So this is what we do. We do it well. We do this as what we do for a living. We're looking for clients that are like, take the investments. Obviously, they play a major role in how we're constructing the portfolio, but we're basically doing the lion's share of the work. And it was to kind of eliminate the too many cooks in the kitchen. So we feel that this hybrid model allows us to work with clients that have zero assets to clients that have hundreds of thousands, if not millions of dollars, and do that over the long term.
Great stuff, Tim. I think it's a great summary of how we've evolved over what is going to be 10 years this fall, which is crazy. And where we started and what we've learned and how we've pivoted. And as you said, I was actually thinking about this morning as we were prepping for this. It was way back on episodes 15, 16, and 17. So this would have been back in 2017 that we talked about some of this topic and why we landed on what was income and net worth at the time, which was revolutionary Tim Baker style of fee assessment. And how that worked for a season, but we realized where that kind of broke. And I cannot emphasize enough that we really believe the ROI of the relationship. Not only is it beyond just the quantitative, it's also the qualitative, which gets
Totally.
overlooked so much in this industry, and it's harder to measure. But even on the quantitative side, it comes from the years, as you mentioned, of compounding these wins and having the accountability and stacking those. And if that's an 18-month relationship because the fee structure doesn't align such that it can't be continued on, then you reduce the ROI of that long term. And so, that's in part how we've arrived to the point that we have today.
Yeah, and I would just piggyback on this. Like, there was a study done by our friends up north, the Investment Funds Institute of Canada. They did a study, Tim, from 93 to 2008, that basically looked at what was the impact of net worth or assets, with, a group that didn't work with an advisor, and then those that did. And, the impact on net worth for advised individuals was greatest by the end of the study period, suggesting that the impact of a financial advisor grows over time, which is kind of like, no duh, right? But I say that
Like any other
because,
coach, right?
yeah, I say
Yeah.
that because, like, in a microwave society, we want results yesterday. Completely get that. But, they have a graph that's basically like no advice compared to, those that, have advice for 7 to 14 years. It's typically like 2x. Now, I think based on what we do, like, our results are a lot better than that. No promise for future, like, that's not a promise, but like, I feel like the transformation that we show with clients, it's actually more impactful because I think we just cover a lot more than the traditional advisor. So, to me, it's important to, what you're saying is that just like invest in the value of advice compounds over time, and it's stacking, months, quarters, years, decades of really intentional planning. And I tell the story, when before I was in, financial services, I was a logistician. I worked in warehouse. And so I would drive to the office at 5 o'clock in the morning, go into a warehouse with no windows, you work all day, 12 hours, leave the office at 5 or 6, drive back in the dark. And I wouldn't remember those drives at all. I was just on autopilot.
Mm-hmm.
And I
Mm-hmm.
think part of that, like that can be an analogy of life. And part of working with a financial planner, I think a good financial planner that's looking at the life plan is questioning, like, are we on track? Is this
Right.
still what we want to do? Like, let's have some introspection. And sometimes it requires a third party to ask those pointed questions to say, like,
Mm-hmm.
hey, let's get off of of autopilot, and let's ask some
That's right.
pointed questions about, is this a wealthy life for you today? And are we on track for a wealthy life, 10, 20, 30 years in the future?
Tim, and I'm even thinking about our weekly team meetings
Yeah,
where when we talk about the impact of the team, yeah, I mean, of course, we love seeing the net worth numbers go up. We love seeing the numbers in the right trajectory, long term, and we certainly, have seen that. But it's those life type of wins where it's like, oh man, this is when I feel like I could run through the brick wall, right?
totally.
It's someone who's been talking about doing this life dream for 5 years, and we've moved the needle. I think about some of the examples we've talked about lately of someone really pursuing a passion and hobby and around horses and the passion they have there. Previously, somebody who looking at their experience as a pilot and ultimately, having a fraction of a plane. Or I think about Jess and I in our own journey and some of the decisions we've made as a part of our own life plan. And like those are the things that individually, when we think about significance, meaning, and impact, but also as we celebrate our clients as a firm, like that's when the team lights up.
Yeah, and I just found out recently, the pharmacist you're talking about, that huge amount of student loans, credit card debt, and you fast forward a couple years, and she's essentially flipped her net worth from negative 300 to positive 300 in a couple years. And that's not what she's talking about. She's talking about
Mm-hmm.
Pickles the horse, the big old diesel truck that she has, moving from one part of Florida to another to be closer to the National Equestrian Center. She actually just emailed me this week saying that she bought another house. So we're working through that. But the other big thing for her, when we talked way back in the day, is she's like, I've always wanted to do an African safari. So early this year, she told me she booked a trip with her
Love
mom to
it.
do an African safari. So, like, those are the things, Tim, where it's a lot of pharmacists will say, you guys are scientists. You want to weigh the scales of like, hey, if I pay this fee, am I going to get that back? What's the ROI? And I put that back on its head of like, well, what do you mean by ROI? To me, we need to be technically sound so we can make sure that, a lot of financial advisors will say, and that would be a question I would ask is like, how do you guys measure progress? A lot of financial advisors will say, look at me, I got you a 10% return on your investments. But who cares if you're like drowning in debt or you're living a life that doesn't necessarily line up with,
That's
your
right.
goals? Money's a tool, right?
Yep.
So to me, quantitatively, it's net worth. And then what are the qualitative things that are important to you? And are we doing something about it? Part of our job is to hold the mirror up and say, carrot and stick. Hey, Tim, I'm talking to myself. Hey, Tim, nowhere in your financial plan does it say that you need to lead the league in bottles of whiskey in your collection, right?
Although you do.
I do.
Yeah. Yeah.
But like, that's not in my financial plan. So like, if I'm like in a pinch, or if I'm not like doing the other things on my financial plan, my
Yeah.
advisor just to say, hey guy, like, how about we not spend this money toward, the whiskey, and like, let's like this bucket that's been sitting dormant that you want to do X, Y, and Z, where show me the money, right? Because at the end of the day, Tim, we're not gonna lay on our deathbeds and say, oh man, I wish YFP, or I wish my advisor would have said I would have told me to put more money into our Roth IRA. We're not. We're gonna say, I wish I would have got into horseback riding again because it was a passion of mine that I just put on the back burner because I think I couldn't afford it, or it wasn't a priority, or played in a band, or changed careers, or became a pilot. That was, those are the things that are transformational, inspiring. And I could talk about this all day long. But that's what this is about. It's not about, the ones and zeros. It's not. We need to do that to make sure we keep our job and we push this forward, and we need to be technically sound and all that. But to me, it's about aligning the life plan with the financial plan and holding people accountable to that. And I think that's a big thing, is having a third party that knows your goals, knows your balance sheet, and has your best interest in mind. So, yeah, I think that's super important.
Yeah, as we say all the time, right? It's are we living a rich life today while we're taking care of our future
Correct.
selves, right? That's the quantitative and the qualitative. And I get it. It's an analytical audience, right? I am an analytical pharmacist. Like, the ROI is a good question as we're talking about, the numbers. And even as we're talking, I'll link to it in the show notes. I'm thinking about the Vanguard study of putting a value on your value, and what's the actual potential quantitative ROI of an advisor. And it's really interesting because when they look at those numbers, it comes from several different things, whether it be asset allocation, saving on expense, rebalancing, but the behavioral coaching is a huge chunk of that, which people I think underestimate, in part maybe due to some overconfidence. But what's missing from this table altogether of the ROI is what is the qualitative side
Qualitative.
of
Yeah.
that. So
Yeah. And I think the Vanguard study that was done in 2001, a value of advisor to alpha, it's narrow in a sense. I think it looks at a hypothetical portfolio, $500,000 over 25 years, with an advisor, that's managing it. It grows 8% per year, or to 3.4 million. For a self-managed, a DIYer, it's 5% per year. So it grows from 500,000 to about 1.7. But again, I say that's too narrow. Like, if you want to look at quantitative, talk to me about net worth, not
yep.
investment returns. If you want to look at the whole thing, I want quantitative, I want net worth, and I want the qualitative stuff. Are you living a wealthy life today? Like, are you doing the things that you're passionate about? So I think that to your point, like, pharmacists, what's the ROI? Like, what's, what with them? What's in it for me, Tim? Like, I get that, but I would turn that question right back to you, the prospect, the listener, to say, like, define that for me.
Yep.
Like, how do I know, we're scratching that itch? And I think it's a little bit more than I give you this fee and I get this back in some way.
Great stuff. So that's our third question. How are you compensated? What's included in the fee? How do you calculate your fee? Is it transparent? We broke down the different fees that are common in the industry. The fourth question, Tim, I'm going to move past this one quickly because we've already addressed it in the areas we've talked about. The fourth question is, what are your conflicts of interest when working with a typical client? And if we go back to the three different buckets you mentioned in terms of the commissions, the fee only, or the fee based, or the fee and commissions, another term for that fee based, you can start to identify where those conflicts of interest may be. And as you say often, there is no such thing as conflict-free advice, correct?
Correct. I think it's Tony Robbins in one of his books. He talks about conflict-free advice, and there doesn't exist. It just doesn't,
Yep.
So to me, if it doesn't exist, tell me what the conflicts are, and let's talk about that. Let's be
How do we
upfront.
manage them?
Yeah, and I think oftentimes, if you're dancing around that question as a planner, there's problems. So, you know, and that's, I think, one of the frustrating things sometimes is someone's like, I want to work with a fee, like a fee only person, and I think I'm working with them, and I'm like, you're not. But then, like, there's some inertia to change. Even if that they're not fee only or whatever, or that you don't really know what they're paying, and like there's inertia there, and I get that. So, to me, it's having that conversation, and I think often those conversations are buried, or it's we talk in circles until we can get through the question, and then we're on to the next thing. And again, I just think be transparent, right? Like that's huge. So, are you obligated to act as a fiduciary all the time? And I think that all the time is the operative word, because in some of these models, fee based, you can say I act as a fiduciary, but it's only when I'm working with ERISA type funds like a 401k, because that's the Department of Labor is trying to like really narrow that down, not some of these other entities that I think should really be drawing a firm line.
Tim, our last question and 5 questions asked when hiring a financial planner is, what is your investment philosophy? And I would argue, Tim, this is an important two-way conversation, because the investment philosophy of the firm, is there alignment there with the investment philosophy or preference of the client, right? So talk to us about why this is important. I think this one gets overlooked a lot, that someone may have a preference, but that doesn't necessarily align with the firm and how they approach their investments.
Yeah. So one of the questions I ask a prospective client is like, if you had to make a list of the things that you want in your financial planner and or in your team for you to say like, hey, these are my people. The one of the things I'm kind of looking for, and I think very rarely it comes up, but sometimes I'll see people that are like, I need you to beat the S&P 500, and I'm like, that's not us, right? So we believe in more passive, buy the market, don't try to beat the market. If you're more of an active, investor, you think that there's ways to kind of game the system and beat the market, and only one person I think can consistently do that, Warren Buffett, who can buy companies and basically extract return. Most of us can't do that. So it's are you trying to beat the market, or is it kind of more of a singles and doubles approach where you're in the right asset allocation, you're in the right asset location, we're keeping expense low, those type of things. So a lot of people are like, I don't know, what is your philosophy, and see if that works for me. So I think if you trust the market and you let it do its thing over the course of long periods of time, 10, 15, 20, 30 years plus, the market takes care of you, right? So you waste a lot of time and money trying to like game the system. But it might be like, in this day and age, like, what's your opinion on digital assets, right? So for a long time there, it was kind of similar to student loans. It's like, don't worry about it. And now digital assets are, it should be something that your advisor is at least talking to you about. Do you like Vanguard funds? Is it ESG, which is like sustainable investing? Are there different strategies, that make sense to you, that fit more into your portfolio? So I think a conversation about this is super important. And I would say a lot of the time, prospects will take the lead from their advisor, whether they're active or passive. And I grew up in a, where I not grew up, but my previous firm, Tim, kind of helped mold me of where my investment philosophy is. And it was more of a case of like what not to do.
Yeah.
So, when I was being mentored, we basically selected investments from the people. They would come to our office, these wholesalers, these mutual fund wholesalers would come to our office in a fancy car, wearing fancy suits, and they would take us out to a fancy lunch, and they would show us fancy glossies of like why their funds were so great.
It's like old school pharma, man.
Yeah, exactly.
Yeah.
And they would say, hey, Tim, when Tim Ulbrich rolls over his money, like wink, wink, like use our funds. And to mobilize a sales force like that costs a lot of money, and who pays for that? The investor, and it's typically in the form of commissions or an expense ratio.
Mhm.
So, you know, that was our criteria to pick, large cap, mid cap, small cap, like these different, sleeves of investments, and they were often super expensive. The other mentor that I had was, it's more of an active strategy. It's like, hey, client, we're going to buy XYZ ETFs at $100 per share. And then when it goes to 110, we're going to basically put a stopgap at
Mhm.
105 and then kind of lock in our gains. And if it goes at 105, we'll sell out and then we'll live to fight another day. And, we'll look at the VIX and all this kind of stuff. And we have core and we have explore positions. And the problem with that model was like there was I remember being at a conference and there was a flash crash where something happened in China and the market went down and then went back up. So in this scenario, let's say we had a sell order at 105. By the time we actually got filled, because some of these ETFs were thinly traded, I mean not a lot, it got filled at 80.
Right.
And then the market's back up, and now we sold at 80 and we're trying to buy at 110 or 102 or something like that. And I'm like, okay, mentor, what do we do next? And it's like, I don't know. So so
Mhm.
that was more of the active strategy. And I'm like, you know, there has to be a better way. So
Mhm.
I read books like The Index Revolution, which is a quick read that is kind of like what I would say. It's like, hey, trust the market. If you
Mhm.
read something in the Wall Street Journal about a biopharmaceutical stock that's been priced in many, many weeks ago, like it's not a hot stock tip. Um, so it's kind of the more boring investment is, the better. Investment should be like paying down a debt or watching paint dry. Typically, the more
Mhm.
sexy it is, the more expensive it is, and the more I think risky it is. So it should be super boring, singles and doubles. Don't try to hit home runs. And often you want to do the opposite of how you feel. So if the market's crashing, you want to take your investment ball and go home. Don't. If you have more money to put in, do that. Not investment
Mhm.
advice. If the market is flying high and people are like, I want to buy, you have to be cautious because it goes in cycles, right? So you will often want to do the exact opposite of how you feel. And these are the behavioral things that a lot of people get in trouble with. They'll sell low, they'll buy high, right? And, part of our job is to kind of, establish a structure and a framework to potentially talk you off the cliff from doing things that are rash, and I've done that in the past before, getting into financial services. I've done silly things with my investments, which I regret.
Tim, it reminded me of Daniel Crosby, who wrote
Mm,
The Behavioral Investor. Had a chance to interview him on the show.
yeah.
I'm drawing a blank on what number it is. We'll link to it in the show notes. But one of the quotes from The Behavioral Investor that he had was, "Humans are wired to act. Markets tend to reward inaction."
Yeah.
And I love his take because he brings a research based psychology approach to how you think about your money, and a little bit of dose of humble pie, right? When you understand the limitations of what we can do. And great recommendations. You beat me to it. I was going to mention The Index Revolution by Charles Ellis. If folks are looking to read more on this, Unshakable by Tony Robbins is another good one that touches several of the things that we talked about during today's show.
Yeah, and I would just say, Tim, to add to that, like sometimes I get the question from prospective clients that are like, oh, do I need an advisor, or should I, do I have enough money, or things like that. And there's always going to be a population of people out there that are DIYers, and whether that's, handling your money, mowing your lawn, cleaning your house, whatever that is, right? There's always going to be that. I would say for the most part, though, if you're a pharmacist and you're making a six-figure income as a household, and we're aspiring to be, a seven-figure pharmacist to kind of take from the book, you need an advisor, right? Like pharmacists are pharmacists. You do what you do. I think with the amount of money that we're talking about, and I think the intentionality that we're really trying to focus on, like you hire a financial planner, right? And I think sometimes I speak with pharmacists and they're like, oh, they're not sure, or to give themselves permission. Do I have enough? And like I said, we work with clients that are all over the map in terms of their like where they're starting net worth, which is very, very negative or very, very positive. And I think to me, this is about building in a foundation and intention with your money and letting, a professional, do that versus, kind of you doing it on the side. Cause I think there's a lot of, positive aspects from obviously the technical stuff, but then just like the optimization. And I think one of the things that one of the prevailing things that I talk about, that I talk to, that's missing is like, am I optimized? And is the money that's kind of flowing through my household, directed in the best way possible? And there's a variety of ways to look at that. So I would just plug that, if you're listening to this, you probably do need a financial planner, obviously by a sector, right, Tim? But I would just throw that in there.
Really good stuff. I know we covered a lot of ground. This is one of our longer episodes, but I really feel like one that we're going to be able to come back to on repeat of, hey, what are the things that you should be thinking about, looking at, questions you should be asking when you're thinking about hiring a financial planner. And we're really proud of what we have built, our team of CFPs, certified financial planners at YFP, the impact that we're having. And we would love to have an opportunity to talk with you, whether you work with an advisor now or not, and this may be your first engagement. We'd love to have a conversation to learn more about, hey, what's going on in your financial plan? You can learn more about our services, and together we can determine whether or not it's a good fit. You can go to yourfinancialpharmacist.com, and right at the top of the page, you'll see an option to book a discovery call. We'll also link to that in the show notes.
Yeah, thanks, Tim.